Morning, everyone. Michael Atwell from CBRE. Generally, what is one of the biggest challenges, the main challenge in Central Europe is the challenge of the opportunity of actually acquiring assets. And yet, if you look at the environment we're in, we have low interest rates, we have good core, top quality assets. There's no end of weight of capital trying to get into the market, but it's struggled, it's challenging, it just can't find the opportunities. Mix all of that in with some very, very different occupational markets. You can see it's quite an interesting mix. And then if you look specifically around the region, you'll see big differences from Czech, Hungary, Poland, Romania, etc. The weight of capital, you can see as the slide slowly comes through, there's a lot of capital coming into Europe. Now within Europe, there's 223 billion of investment activity. Central Europe is a relatively small scale in that sort of picture. But what is happening is there is a huge amount of capital trying to get into our market, and it is challenged. They're all the main players. There's where the capital is often coming through. There is new capital coming in as well, and quite often it comes through new names. But most of the time, whether it's new Korean capital, whether it's new Chinese capital, it will come through a Heitman, a Heinz, a Rockspring. So you won't always see the new capital because they'll be coming through a well-known investment manager. So there's an increasing allocation to real estate, and I'll touch on that later on. The weight of capital is increasing. The well-known players are bringing in new equity as well as their existing equity. The debt market, Walter and Michael, you are more and more open than ever, what I understand, and I'll touch on that later on. And Western Europe, I was on a call yesterday morning where it suddenly became clear that Western Europe is surging ahead in terms of volume of activity compared to Central Europe. So the main point I want to try and say is Central Europe, is it lagging behind? Have we stagnated? What's the reason for that? In the market, the guys who are on the ground in the market, we're extremely busy, very active, and yet if you look at the statistics and the data, we are lagging behind the activity of 2006 and 7. So Hungary, for example, is 75% less activity than 2006, 2007. Poland and Romania both about 50% less activity. Now, I didn't realize that until these stats came through yesterday. So why is that? And is that controversial? And Russia is slightly down as well. So why do we see this Central Europe lagging when the GDP picture, the macroeconomics, is extremely good? September this year, is fine. More importantly, if you look into the next 5 years, we've got solid GDP growth, particularly of 2% plus across Central Europe. Investment volumes at a European level, if you look back to 2006, 2007, on a European level, you can see we're nearly back at the same level of activity. If you look, however, in Central Europe, excluding Russia, and I shouldn't say this, I like to exclude Russia in CE discussions because it's a totally separate market. Look at the chart there. You can see the activity of 2006 and 7, and look at the activity 13, 14, and we'll come on to 15 in a minute. You can see there's a big difference. So why is that? And that will be a question which will come out in the debate. Again, the issue in 2006 and 7 was open availability of debt. What's happening now is we've got plenty of equity, the debt markets are back, so you've got what I call the double whammy effect. Too much equity, too much debt, not enough product. What's a historical trend? I don't want to scaremonger things, but if you look historically, back from the 80s, which some of us will remember well, every 9 years or so, the US has its downturn. And if you look at 2000, saying August 2009, is it 7 years, is it 6 years? So 2016? Surely not, because there's no sign in the future as to what's going to be the next downturn. We've got 5 years on that slide showed earlier, 5 years of positive GDP growth. So there's nothing on the horizon that will indicate a slowdown in this. But something has to happen, because look, historically, every 9 years or so, boom. So what will that be? Panel, you can discuss that one later. But I was asked to put this slide in, because if you look at this, again, this is one of Josh Trump's favourite slides, is the gap is between government bonds and real estate is the widest it's ever been. So therefore, is it the best time to invest into real estate? And funny enough, in 2006 and 2007 was when it was the closest. So a lot of money was going into bonds then, but government, German 10-year government bonds now is almost just non-existent. So why not put it into real estate? If you can get an overall net return of 4% and buying a core product, that's great compared to a government bond when you're getting virtually nothing. Across Europe, I'm just doing a slide on each, offices, the rental growth forecast for offices around Europe, and look at Warsaw. Now I, and Adrian as well, I'm a great supporter and believer in Warsaw offices. We're just going through a bit of a tough time at the moment because developers like Skanska, they just keep developing. So we've got this massive development pipeline in Warsaw, but the occupational demand is 600,000 square meters per year take-up. But Skanska keep building too much. But no, give another 18 months, we'll see that will be a very different situation. The take-up would have taken up all that construction. But you can look at that, there's no rental growth, so therefore, should I be investing in that? Industrial, Robert, the zero rental growth forecast. Why? Is it because the developers just keep developing? Land is cheap, land is available. May not be cheap, you'll say, but it's available. But the occupational demand, how do you find the occupational demand? It's great. So again, it's just the balance of supply and demand, but the occupational demand is very good. Poland showing great, or let's say strong growth on retail sales, and yet if you talk to retailers, you talk to developers, you talk to shopping centre owners, it's really tough at the moment. The good quality retail is doing well, but there are challenges. And leasing shopping centres is as tough as ever. Incentives are going up, rent-frees are extending, and so on. So why is that? We've got a great retail growth story, and yet retail is viewed as quite a tough market at the moment. So the yield story. Do we expect further yield compression? Andreas, I'm sure, during the panel session will say yes. We expect a lot more yield compression to come through, just because of the whole global market of, the yields will come down. If you're acquiring an asset, what's your exit yield? Do you expect that yield compression? A lot of investors are not putting much yield compression into their exit calculations. So, and yet, some people view there should be. Where the strong, and particularly strong and encouraging sectors, should we be chasing yield shift, yield compression, or income security? If you look at the income security side, we've all been, if we all come from a real estate background, we've been through location. That's all you ever learned at college. You came out of college again, location. I flip that round. It's not. It's lease. If you've got a 10 or a 15-year lease in Central Europe, or well, actually anywhere in Europe, lease and a secure income is driving value at the moment. We're seeing prime long-leased assets trading at very, very low levels or yield levels. We're currently selling an Amazon portfolio. I'd love to say where the first round bids have come in and the second round bids during the end of this week, probably today. You'll all be very surprised where industrial yields in Poland are going. But it's because of the lease. It's a 15-year lease, Amazon covenant. So do you put that, or do you do a government bond at 25 bips, or you do it's all down to the lease and the income security. We need to really understand those occupational markets. As I said, you look at Warsaw's offices, you go like, oh, never touch it. It's a basket case. If you understand the market, there are very strong reasons to invest into offices in Warsaw. Retail, you see the figures, there's great retail sales growth, but you have to be very, very careful. So understanding the occupational markets, the trading potential and so on is absolutely critical. Very quickly on yields, all of these slides are fairly similar. We've had the yield compression. If you look into offices, vaguely, roughly stable. Again, industrial, it's all stabilizing across the region. The only one where we've seen a sudden drop is in retail in Czech Republic, because palladium sold at a record yield, so boom, down goes the chart. Will it come back up with the next deal? Yeah, and then Riviera in Gdynia, that traded at 5.4. That was a record yield really for retail, or close to record yield. And just quickly in volumes, you saw that before. Poland is always the dominant one. But look at what's happened in 14 and 15. You know, H1, 14 and 15 are fairly similar. But at the moment, H2 2015, I think, I'll be happy to be proved wrong, I think volumes will be way down on last year. And that's mainly driven, in my view, by the lack of big, high-volume deals. If you look in Poland last year, there was Metropolitan, there was Rondo. If you don't have the big, high-volume deals, the overall impact on total volumes is reduced. And look at Czech Republic, people are saying, oh, Czech Republic, the volumes are up, it's great. One deal, I mean, one swallow does make a summer, as I say, but you know, if you've got to be very careful and analyze the markets as to where the volume is actually coming in. Russia, although I said, yeah, I'm not going to cover Russia, but very different volume story there, an investment market. Obviously in 14 and 15, 14 is obviously obvious reasons why that slowed down, has slowed down. But our team on the ground is, fair to say, Andreas, more active than ever. I wouldn't say there's a huge amount of transactions, but it is an active market. It hasn't stalled at all. And there are some of the main investors. So there is sovereign wealth money looking in there. There's Heinz. There's well-known names are actually active in that market, but less, a completely different list of investors to Central Europe. There's the debt slide, which a couple of these guys will react to. And when I was sent this by our internal teams, I went, you know, okay, Poland, 70 to 75%, yeah, that's at tops. But 120 bips on the margin, that to me was, so that I'll leave that for you two guys, the bankers in the room, to have a discussion later on. Yeah, those figures are there, but then particularly look at Romania and Hungary at 300 and 350. So there's a huge finance cost gap between those markets. The other area which is always of debate is on investment volumes is, should you include corporate acquisitions? So should the volumes of all the GTC assets, should those have been included in investment volumes last year when Lone Star acquired? They acquired initially 40%, and I think it's now 66% or 60% of GTC. They haven't been included in volumes in the past. Griffin and Echo, there's a debate. Our research people said they should be included in there, but it's a corporate acquisition. It wasn't the real estate that was traded. It's still Echo own those assets. If we do include them, Poland shoots up in volumes by 1.5 billion roughly. So, but I think at the moment the view is they shouldn't be. But maybe by the end of the year, if people see it's a very quiet year, they're going, oh no, let's put them in. And the Investment Research Forum, these volumes are all agreed by Investment Research Forum. So it's by all the agents, sit on the Investment Forum, and then we all agree whether we need to push the volumes. TPG Trigranite, obviously, is fair to say it's nearly there. And you know, P3 last year was taken by TPG. So there are, now what's the reason for this? Is it because they can't acquire the assets? Is it because it's so difficult to get stock? Therefore, buy the company, and that could be a reason for it. And then look, very quickly, although I'm saying, oh, are we lagging behind? I won't go through these and just flick them up quickly, but if you look at, these are just snapshots of some of the investments over the last couple of years. You know, the key ones, Rondo, Metropolitan, Atrium, New City. So there were some big volume deals traded mainly through 2014. The regional cities in Poland have been super active. Partly people are running away from Warsaw because they're scared and running to the regional cities maybe. Adrian, you know, obviously is active in both. Skanska's active very much in both. And Skanska's probably put a big push on regional cities, haven't they, at the moment, and continuing to do so. They really believe in the regional story. Retail, we've seen some huge transactions over the last few years from Silesia City Centre, which was a couple of years ago, through to Kazimierz, Placuni, Wola Park, and Dominikanska. So I thought Dominikanska was one of the record yields. And then, obviously, the highlight of this year has been obviously Palladium in Czech Republic. That's a significant deal. The largest ever single asset transaction in Central Europe, I think, unless anyone can think of a larger one. Then Hungary has had lots of activity. Tim O'Sullivan, my colleague there, he sees it's very active, but again, there's certain challenges in getting deals over the line. Investors are still looking at Hungary, yes, but when it really comes to it, there is a bit of hesitancy. Now, whether that's because the finance costs are so much higher, or whether it's just the uncertainty of the government. I was at a conference there last year, and there was political risk and government risk was 85% of the reason to not go into Hungary. And that was a consensus of about 300 people in the room. So there's still that fear factor over Hungary and what's going to happen with the government. Slovakia, there's been high volume deals done in Slovakia as well. And lastly, Romania, again, there's been good activity in Romania. And I see those new, let's call them the newer markets of Central Europe, they will be picking up activity. Investors may be frustrated by core Central Europe, Poland and Czech and Hungary. They're now going to start going further down into Romania, Slovakia. What about Croatia? Those are new markets which you guys can all debate. Done.